Hey traders, Stephen here. It's Friday morning, June the 7th. We're going to look at the market. We're going to look at a lot of the individual sectors to see if we can find any pockets of strength that have potentially held up during this correction. So let's really get right into it. So I'm looking at a similar chart we looked at last week, but some more developments have happened, so I'm going to keep it up there. Last week I talked about, okay, once this neckline is broken and if it breaks the 200-day moving average, we could see a waterfall effect. In my opinion, this isn't a waterfall. That did not happen. Waterfall, you're looking for kind of 3 to 5 hard days of just straight selling straight down. And even though one could argue this is, but typically they're a little worse off. So I'd kind of say we got a half waterfall. I also talked about these two pivots right here getting picked off in the waterfall, like why it could happen, because the market will gun for these stops and these stops because they're just little small pivots, but that's where stops are being held. And it picked off one of them, but it hasn't picked off the second one yet. So to me, I kind of see that as a positive, although it still could. So now on the bounce back, like we're right at the neckline, we're right at the 20-day EMA. And the futures are up slightly, ever so slightly, but I think the numbers is about to come out for the jobs numbers is about to come out. So we're really at an interesting point to see what's going to happen here. One thing I do like, we could get a surge above and then it slammed back, kind of like this, right? You kind of have this downtrend and then you get a pop above, sucks everybody in, and then slam. And then you get a pop above, sucks everybody in, and slam. So really be open to anything, but sometimes when the rally line, the 20-day EMA starts to curl a little bit, that gives me a little bit more confidence that we could even get a pop and then a pullback and then it could kind of take off. So a lot of times I really do like to kind of play the rule of three. If it rejects a second time, I'm typically looking for the third time to work. That doesn't mean the second time can't work, so I'm keeping, you got to really keep an open mind. That way you're not too biased one way or the other, and that way you're not too biased if the market starts to rally and you think it should go down, and you're sitting on the sidelines in cash. I made that mistakes, too many times, so I'm just trying to always keep an open mind, be flexible, and bend with the wind, and anything could happen. So really, I think we're at a come to Jesus meeting area right in here, and we're just going to have to wait and see, if we surge above it, if we get a kind of a follow through day. I think you got to go ahead and stick your toe in the water with something small. I sent an idea out to my subscribers like, hey, if there's just nothing out there that's screaming a buy, like to me, there wasn't a whole lot out. There were a couple stocks, but they moved so quickly I couldn't catch them. But if you want just a little bit exposure, sometimes it's okay to just buy a market ETF like an SPY. Oops, sorry about that. Or an IJR, something like that. Just a small position to have you in the market, but that way if it rolls over, and you have a stop, you're likely only to lose 3% versus, 8 to 10% on an individual stock. So it just gets you a little bit invested, right? That way if you're right, then you can, and the market continues, then you can kind of go for the more aggressive stocks. So that's just an idea. So right now we're almost 5% off this low right here. So once the market opens, it'll be like right at 5%. So, what I did was say, okay, if I go to this zigzag chart, just to show you how common it is to get these rallies and corrections, but how easy they can suck you in. So, we had the waterfall at the beginning of 2018, and this is a zigzag chart of 5%. So it means any line is a 5% move. So you had a bounce of 5%, and then it just got slammed down. And then you had a nice leg right here, and then, a bounce of 5%, then it came back but didn't undercut. And then look at the bear market at the end of 2018. You had 1, 2, 3, 5% rallies in the market before it just went to the slaughterhouse. So I'm showing you that to show you this, like don't just get too excited. Just slowly let yourself get in and just kind of have a mechanical rule set for your exit strategies, because that way if they all work, then you can put more money to work. But one thing I recently learned is, try not to have too open units of risk. And what that means is, if you have, you buy 2 stocks, and if they haven't hit your target one yet, or your stop, don't continue to add more positions until at least, one of them hits your target one, so it's a scratch trade. Then you can add another trade, because if you're sitting there loading up 4 stocks and none of them are going anywhere, none of them hit your target one, then they all roll over at the same time, it's going to be a bad day. So just kind of keep that in mind. So, stick your toe in the water with 1 or 2 positions. If they start to work, or one of them hits a target one, then you can add another, and then you can add another. That way you're not top heavy in case, something like this happens, which, is highly possible. All right, I'm not making predictions, but if we go back and look at this chart, we are at an interesting area. So just keep in mind risk. That's all we're trying to manage right now is risk. If we look at the Russell 2000, this just really continues to look weaker, and I like to go after some faster moving growth stocks. And so, a lot of them are probably in the Russell 2000. And, they haven't really done very well, because you got that there's definitely kind of a risk off type of environment right now. Even when the market bounces, you get a surge, but it's right at that 20-day moving average, just like everything else. So this is a test. If this tests and fails, it could roll over a lot. So again, if you want to stick your toe in the water, maybe just use something like an SPY, IJR, something. I'm not telling you not to trade. I'm just saying, if you're unsure but feel you need exposure, go with a half position, or go with kind of a more conservative position, just to satisfy your need to stick your toe in the water without having the potential of having a position absolutely blow up on you. Just a thought. So if we go over to, okay, we can kill that chart. Let's go over to breadth, and then I want to look at some of the FANG stocks, and I want to look at gold. I want to look at oil. So, breadth has came back the last 4 or 5 days. So that's a positive right here. You have 65% of the S&P 500 stocks above their 20-day EMA. Get a little bit higher, and we're looking okay. But kind of looking at this, what's the strongest? Technology is still only at 55. Financials is at 71, so that is bullish. Healthcare is at 72, so there's a pocket of strength. Energy is still horrible at life. That's just a joke. But no, energy has been in a downtrend for a while, so they're a weak sector. You got materials that has really popped 76%. That's the gold, and we're going to look at that. And then you have utilities, which is at 92%. So the strongest, the strongest is utilities, the weakest is energy, and then you have a lot in the middle that are doing okay. Okay, so I would not say this is a bad picture. I would just kind of look for a little bit more thrust. So if we look at the long term, where is that? Look at the long-term breadth, which is what I like to look at for trend analysis. So now we're back above the percent of stocks in the S&P 500 above the 200-day moving average is 61%. We're back above the line where we need to be back above. So breadth is improving, but you can see that can happen in corrections. It can kind of whipsaw around this. So like to see the technical picture improve just a little bit more, for us to have a continuation, but we're moving in the right direction. We're just, at that point where it could break through or go south pretty quickly. Let's look at gold. So gold is really interesting, and it really always keeps you on your toes. So if you look at the GLD chart that's been in just a big sideways consolidation for a while, you have, a huge cup with handle. Could call it a flag, call it whatever you want. That's a bullish breakout right there, okay? So the GLD is looking good. Now let's go down to the minors. So I think this happened last Friday, and I fell asleep, and then I noticed it after the market, and I probably should have started something right here, but it's gone straight up. So I would look. I think this is just a really bullish development, and I don't know if this is just a true risk off, or sometimes gold can just run because the dollar could roll over, but we'll just kind of wait and see. Sometimes I try not to overanalyze the opposite correlation sectors, because a lot of this stuff can decouple over time. So you just really want to pay attention. I just price and volume first. But GDX has really gone nowhere for years, and then it rolled over. It broke out right here. I think this 20 line right here is very important, because you can see it surged out of a couple handle right here. Kind of came back and tested it twice, and then it surged again. So because it was a resistant line right here in this pattern, and then it was a support line, and then it broke through, and then it was a support line, another support, I think this is a very interesting level. So if we get another kind of a drift back like this, a flag or something like that, I think we need to pay attention. I'll probably use a starter position in this just to see what happens, and then you could obviously put a stop under here. I think right now it's just a little bit of extended. That's from 20 to 23. That's obviously a 15% move, so you don't want to buy all the way up there. But, let it come to you a little bit. But what also is bullish, you have the GDX versus GLD relative ratio. And, something that Greg Schnell at Stock Charts always taught, he's a commodities guy, is he's like, you want the companies to outperform the metals, right? You want the miners to outperform the metals that they track. And that's more favorable bullish environment. Well, you can see for the most part, going all the way back to 2007, you definitely had your rallies. You've had your rallies. But, this is a pretty important trend line, in my opinion.
Order filled.
Long-term. Okay, so let me kind of repeat that, sorry. So we're at this line right here, going all the way back to 2017. If the miners can just really make a definitive breakout here relative to the GLD, I would think that would be very long-term bullish, because this is you're looking at a 2-year chart right here. So just kind of pay attention to that. With the USD, because usually the dollar has a opposite correlation of gold. You can see the dollar has been consolidating right here. It's kind of been dipping the last few days when the gold is rising, so that kind of makes sense. But still, the dollar is definitely in a long-term uptrend. So you can see that it was in an uptrend. I would say it's in a consolidation, although it's kind of been rising at the top of this consolidation. So this is kind of looking interesting. We'll kind of see how the dollar plays out, but right now the dollar is just really in a pause, the way I see it. And as of recently, at least the last few days, the dollar's kind of gone down. Now I have this RSI 14, and this is to compare to the GDX chart. I want to show that to you. Let me kind of move it up here. Let me kind of update this so you can see it right up against the GDX. Okay, so then you got the GDX. So some people play the RSI. They might play the RSI 5 for short term, RSI 5 for long term. I'm typically not a pullback buyer, but a lot of times what happens is if I see kind of a double oversold dip, right? So you're getting the first dip that sucks everybody in, and then you get kind of one last shakeout, the way I look at it. A lot of times that's a very, very opportune time, and I just want to look at the last kind of couple times this has happened. So right here when GDX, you can kind of line it up with this. GDX sold off, got deep and oversold, bounced, came back, got back into oversold, and then as it's coming out of that, a lot of times that is a decent time to buy. And you can see you would have timed it just perfect. Now over here, you can barely see it, but they did get into oversold, so you had the oversold one that lined up with this, and then the oversold 2 that also went into oversold, and then it just immediately came back out, and then, it absolutely took off. We can also pinpoint it down here. There are 2 little bitty oversold. I might just count this as one, but I think it kind of proves my case. So you have this first dip right here, lines up with this bar, goes up just a little bit, comes back, gets back into the double dip oversold, and then it surges out of there. So my point is, it's the classic shakeout, right? So when everyone thinks it is so oversold, they're like, man, I gotta buy, it's coming out above 30, and they buy, and then they just get one last shakeout. Just like here, one last shakeout. One last shakeout. And this didn't undercut it, but it popped, and then it just kind of floated, retested, just to try to scare everybody out, and then boom. And that's what the market will do. It'll try to scare the bejesus out of you, and then boom, just like this. That's why I'm being incredibly open to the market just rallying out of this when everybody is thinking bearish. Because it broke the neckline, it broke the 200-day moving average, it broke the pivot, it undercut the pivot. It did a lot of bearish things. However, sometimes, but it also created this little hook, right? This little hook right here, and I don't know what's going to happen right here. All I'm telling you is if the market goes up, you need to get in, because everyone, if it kind of breaks through here, it's going to run a lot of stops. A lot of short covering is going to be happening. It's so hard. The hardest thing to do is to not have a bias in the market. Like, you don't want to always have a bias and not being willing to bend on that bias until the market proves your bias correct. Because you can say the market's going down, the market's going down. Eventually, the market's always going to go down, right? A broken clock is right twice a day. So, just my point is, just pay attention and be open to any possibilities. Sticking your toe in the water is really the best way to go. So, let's go to. I did want to look at the oil chart. Is that right here? Okay. So let's just look at West Texas for a minute. This West Texas oil, man, it can really have some serious bear markets. And they're all waterfalls. Like, you can look, I'm sure we all remember this, right? And then it went all the way down to $26. And then this came back, and then you had another 45% correction. And now we're in a 25% correction. I mean, that's a pretty good correction. Okay, so I just want, and there's a lot of selling right here. So just kind of pay attention. I just be careful on trying to bottom fish a little bit unless you see, a legit reversal. And when you see that, I think you want to compare it to the oil stocks, right? Or the oil stocks reversing too. Is everything reversing at the same time? I would look for it on a weekly chart, not just a daily chart. And if that happens, yeah, stick your toe in the water. But I'm just saying, like, don't just see a bunch of red and just throw money at it, just hoping that you're going to catch a bottom. I think that's just, over time, it's a money-losing strategy because you're going against the trend. So let's kind of take a look at the sector spiders. See if I can do 10 per page. All right, so right now we're going to look at the 10 sector ETFs. I think it's very important when we're looking for stuff that is holding up, really stuff that is holding up above the 200-day moving averages, as some of the major indices did not. So we're looking at discretionary, and obviously this charts look the same. You got discretionary technology. Both of them just had a nice pullback to the 200-day moving average, then bounce. Okay, I mean, that to me is a nice little setup. You had support right here, you had support right here. Obviously, it could do this, but, I think right now you're looking for stuff that is slightly holding up. I don't think anything is going to be way up here, unless it's utility. Stuff that is slightly holding up versus stuff that is looking weak. So we want to pay attention to what is a little bit weaker. So industrial. It did go under its 200-day moving average with the overall market. So, I'm not telling you not to find a good industrial stock. I'm just saying, I would not, if you have a choice, and as individual investors we do, focus on the one that's just shown a little bit more outperformance. Materials. Now, this one went way under and then shot way out of here. So, at the moment, I'm going to give this almost a pass. The fact that it went under the 200-day moving average, just because I saw what gold did, it made a 5-day parabolic move, right? And there is a ton of volume coming in this. So sometimes, it's not always a science, there's an art to it. But I think that some materials, some of the stocks on my watch list in the last week, some of the strongest ones have been materials, have been gold stocks or mining stocks. So I think that actually, even though it did go under the 200-day moving average, that might be a nice honey hole to fish in. Energy, it's the weakest. There's just better stuff out there. And it's kind of frustrating because there have been so many times I've been wanting to play energy, but I just look at all the energy stocks and I'm just not seeing a lot of bullish events. You might catch pockets here and there, but you want that broad participation because if 40 to 50% of a stock's move is going to be with the sector it's in, just out of sympathy, why not make yourself the house just by choosing the strongest sector? Staples. This actually, I stand corrected. This is at an all-time high. But to me, that's not necessarily a good thing because staples are defensive in nature. And just my personality and the way I am, I'd rather just, in a bad market, they're all going down. In a correction market, you can get staples and utilities to hold up. So I would just prefer to wait for a more aggressive stock because a lot of times corrections and pullbacks can be very, very quick in nature. A lot of people think, oh, this is the big one, suffer from what I call it's the big one-itis. But by the time you're getting sucked into this, the market could have already bottomed. So I'm not telling you not to. I'm just saying be aware that, you could be getting out of this as quick. It could be a frustrating play. It could be a frustrating play for a couple reasons. One, you could be getting in by the time the stock market's already bottomed, meaning consumer staples are probably going to pull back by the time you get in. But two, if the market gets worse, this is not going to hold up. It is likely not to hold up. It is likely to get shoved down anyway. So your flight to safety thought process is going to get taken out to the woodshed. Healthcare, I would say that healthcare is, a little weaker. It's because it's been living under the 200-day moving average. But we definitely had a waterfall right here, just a nasty sell-off, and then it bounced back, and now it's just really kind of creating, you could say it one ugly, flag, right? Because you kind of had this break right here. If it weren't for that, you could just really kind of draw a flag right here, or pattern, or whatever you want to call it, and it could break out. Utilities is at an all-time high. Again, if you want to play that, by all means, I'd rather be in cash because utilities don't excite me. And I think in a down market, because look at what happened. So in the bear market, you had a lot of, this was grinding higher when the market was selling off. However, when we got close to risk on, about 2 weeks away from the bottom, utilities just absolutely sold off. So when you're thinking, yeah, I'm just going to own utilities because everything's just chugging along even though the market's going down, boom. That's why I just rather be in line with the market. Financials, it has shown a little bit of strength. I think we saw it was kind of up there, kind of middle of the pack. It did dip below the 200-day and now it's coming back. So, it's nothing special, but it's about normal. But really looking at all of these, if you kind of exclude the consumer staples and the utilities, even though this broke the 200-day moving average, I think this is the one I would look at just because of this 5-day parabolic move, right? Then I think you're looking for a short-term oversold RSI 5, right? Dip below RSI 5, come back above 30, look at an entry right there, okay? Because this looks good right here on technology, and I like consumer discretionary. So it's not as bad as you think, the way I'm looking at it. Of course, I'm trying to look on the bullish side. So we'll just really continue to keep our eye on this. Let's look at the percentage gain. Actually, one thing I wanted to do is I wanted to come over here and I wanted to look at some of the FANG stocks. Some of the FANG stocks really got hit, so I decided to throw them up all on a chart. About the time the market, started to pull back a little bit, just to show you kind of not all are created equal. So you have these antitrust laws that are coming out. I think just the government's going to crack down on some of the privacy stuff that has to do with these big tech stocks. I haven't read everything into it, but it's pretty clear what's going on. So you want to look at these and say, okay, which ones are down the most? You have Google down here, looking at all of these, I'm looking at, you can kind of see the percentage gain through June the 6th. I'm looking at Microsoft is really up the best. I mean, Microsoft has held up really well. We might look at that. Facebook, Google, and Amazon are all down the most. Netflix is holding up. So I kind of want to look at those real quick. It's just kind of interesting sometimes to throw them up all on a chart. Now, they are moving together. I would definitely prefer, since these have always been the darlings, for these to be able to hold up. But I just want to look at Amazon real quickly and a couple others. So Amazon, I mean, this is a stock that I think you can, buy and hold for a long time if you can stomach it. But I also think that if you do that, this is a stock that you might want to consider, getting at a good price and kind of just forgetting about it. But if we look at the daily chart, it looks pretty ugly. You had a lot of these FANG stocks, and this is just something I'm keeping on. You had a lot of these FANG stocks just absolutely sliced through their 200-day moving average, right? They were all just gapping down big on big volume, and kind of look at all this distribution that's came in on this pullback, right? So that's the bearish side. If you want to look at the bullish side, if it goes up even a little bit today, let's see, it needs to close above 117.7507. You got a weekly reversal pattern right at the 4-week moving average, or excuse me, the 40-week moving average. That's probably a setup that might be worth taking. You got a weekly reversal pattern right at the long-term moving average. Now, Facebook had a rougher day, but it is still above the 200-day moving average. But, that's some serious weakness right there. A lot of times when you get these gap downs, you might get a snapback, but typically it's not immediate. It takes time sometimes for the price action to eat through all this action right here. Now, if we look at Microsoft, boy, that's the strongest. Like, if you're going to buy one, man, that thing's just chugging along. Yes, it broke the 50, but everything pretty much did at this point in time, right? So this just absolutely came back. Let me look at this. That's a weekly reversal pattern all day. I'm going to add that to my list. See, look at that. Found it. So, if we look at Netflix, again, this one's a little bit stronger. It's just consolidating sideways. No real distribution, no real accumulation. Just being quiet. The relative strength line is moving in line with the market, so I would wait for a curl up. But really looking at all of these, Microsoft, what else? Oh, there was Google. Oops. I need to spell it out. Misspell. Yeah, that one had a bad day. What was that? Down 6%. I mean, that's a big deal. Look, multiple gap downs. Down 7%, down 6 after earnings, down 6% after antitrust. Man, this isn't really one that I'm very excited about. Look at that price action. That could just be, you could have a double top in place, and this thing could bounce into here, and then could just kind of come back down. Look at on the weekly chart of Google. Look at all these weekly spikes. You get one accumulation spike out of 8 distribution spikes. So to me, that's not good. I would be careful if you were trying to play some of these FANG stocks. Look at the weekly chart. Always use a stop, because it could get a lot worse. And I know it's kind of hard to imagine for some of these darling Wall Street stocks to really get in a bad situation, but they've been so good for so long, they might just, some of them might need a big old-fashioned correction. So I hope this was helpful. Let me know if you have any questions.